Hi, I'm Dana Samuelson, president of American Gold Exchange, national precious metals and vintage US gold coin dealer located in Austin, Texas. This is a video gold market update for July 6th, 2022. I'm going to go ahead and share my screen and start my presentation. So this is our company information. This is how you can reach us if you'd like to. This is what our website looks like. We have live, transparent pricing on the most common, widely traded, competitively priced modern bullion items, as well as very competitively priced vintage pre-1933 US gold coins and European gold coins. If we can help you, we'd love to have the opportunity to. So here's our gold market commentary for July 6th. Precious metals and the summer doldrums. It's that time of year when metals can be a little weak as interest wanes while people are on vacation. And we've just finished a long 4th of July holiday. Hope everyone had a great 4th of July. The US dollar remains exceptionally strong for now. We'll look at the dollar chart, talk about the dollar. Inflation continues to be red hot. We suggest if you want to proxy for inflation that you can follow on a daily basis, follow the price of oil. We'll go through the latest gold, silver, platinum, and palladium charts. We'll talk about the physical precious metals arena. The silver squeeze is returning, and the US Mint has made a major announcement about 2 weeks ago about their production for the rest of the year. And we have a couple of $20 Liberty specials that we think are exceptionally good values in the marketplace today. So let's get started. Here is a 2-year US dollar index chart. As you can see, since June of last year, a little over a year now, the dollar has been in a major uptrend that accelerated beginning in March of this year when the Fed started raising rates. And it's now into a very spiky move higher. And that's because the US is the strongest economy in the world, even though we're on the cusp of a recession. Relative strength of the US economy to the Japanese economy, the Chinese economy, and the European economy is higher. So the dollar is catching a safe haven bid of significance. And it's kind of hard to imagine the dollar being so strong when we're going into an economic slowdown, and we may actually already be in a recession. A lot of the economic indicators have rolled over since early May and have weakened considerably. And that's primarily due to rising and strong inflation has pressured interest rates higher, both in the treasury yields, treasury markets, and in mortgages, which has cooled the housing market down. And the dollar's benefiting from these higher yields and the Fed's aggressive rate hike policy that they're under. We're expecting another 3-quarter rate hike at their next meeting. This is from MarketWatch as of today, which helps to explain what's going on with the dollar. I'll read it to you. The currency market is only now coming around to the fears being reflected in the stock and bond markets, which is that central banks will likely be forced to drive rates substantially higher to combat inflation at the sacrifice of growth. Markets are coming to the realization that Europe is going to face an energy crisis and not see any relief. We agree with that. The drivers of inflation aren't going to go away anytime soon. Recession is now more of a global phenomenon, and we're not seeing enough reasons why central banks would slow down in tightening. So the US is just really the best economy in the world of economies that aren't doing so well, and the dollar is benefiting from it. And gold and the dollar tend to trade inversely. Here's a longer term dollar chart that shows where the dollar's been since 2000. And as you see all the way on the right, that elliptical shaped spike that we're in right now is the highest dollar value relative to other currencies, basis the dollar index, that we've seen since 2002, 20 years ago. We've seen a couple of spikes that we discussed in our last update, and this looked like a spike to us as of our May 18th update. It continues to look that way to us, although fundamentally it's a bit better than we thought it might be. We thought the spike that we're in right now might turn into a spike looking more like the COVID spike, which was short-lived, but with the European economy as weak as it is, and the differential in interest rates as much as it is between us and Europe and Japan primarily, the dollar is catching a bid. So we'll see how this all plays out, especially in a recessionary environment and an inflationary environment, which we haven't seen for a long, long time. Speaking of inflation, it continues to be red hot, printing at 8.6 as of the May print, or actually the June print, excuse me. And this is the hottest inflation we've had since 1980. So that's what's forcing the Fed's hand. We think that the Fed will not be able to react to inflation in this cycle the same way they did during the last cycle, which was to get the federal funds rate above the rate of inflation by several points for an extended period of time. We do not think that this is possible for the Fed to do with inflation at 8.6% today, simply because it will disrupt every market around the world dramatically with the amount of debt that we have and the low rate environment that we've been used to for 10 years. It will just simply upset the apple cart to a degree that would be more destructive than letting inflation run, which is what we think the Fed's choice will have to be, which is a pretty bad choice considering inflation became entrenched in the late 60s and early to mid 70s when the Fed did not react swiftly and soon enough. We think the Fed will be in this kind of the same situation this time, but we'll see what their resolve proves to be. In any case, inflation remains very strong, and we don't think it's going to go away anytime soon, even if we go into a significant economic slowdown. Inflation is as much a supply side problem as it is a demand issue. Higher rates and a slowing economy will slow demand, but it's not going to fix some of the fundamental supply problems that we have, especially in energy and food. So if you want to follow where we think the inflation rate will be on a daily or weekly basis, since we only get the inflation figures once a month, you should follow the price of oil. That's what we're doing. And today, oil is trading at almost double its previous 5-year average. And you can see on this chart how it ramped up in beginning of 2022 as Russia amassed troops on the border of the Ukraine and then invaded. So a lot of this problem with the oil market is because of Russia. They're one of the biggest exporters of oil in the world, and now their oil is tainted in the international markets. And we're not going to see supplies fill the demand that we need to keep the economies running, even if with demand abating. The good news is that even though gold's being pressured by a stronger dollar, when compared to other assets since the beginning of this year, gold is actually doing pretty much what it's supposed to do, which is hold its value, while other entities like treasury bonds, emerging markets, the equities markets, and cryptos have taken it on the chin pretty hard in this higher interest rate and financing environment. So gold's doing pretty well. Commodities, of course, the stuff of life, the things that we need are doing very well because the prices of those are much higher than they were just a year ago or 6 months ago, and that's fueling inflation. So let's take a look at the precious metals charts. And all we can say about gold right now is that it's on sale. It has primarily traded between 1750 and 1925 over the last 2 years. You can see that this is a 3-year chart, which takes us to the pre-COVID surge that we saw, where gold was primarily under 1675 an ounce and couldn't get over it until COVID came, and then we surged much higher. The dollar's strength today is pressuring gold to the lowest level we've seen in two years or more right now. And actually it has broken support today under that second to lowest green line at 1750 to about 1735. We don't think gold's going to get much cheaper from here, and we actually think that it's on sale today at these numbers. If the Fed is forced to retreat in the coming months and reduce the federal funds rate because of a weakening global economic situation, and inflation continues to gain momentum, this is a recipe that's ripe for much higher gold prices. So this is a dip that we see as a fantastic buying opportunity. In the short term, we've broken support today at 1750. It may be a bit of a knee-jerk move at about 1735. Ultimately, major support is going to be at 1675, but we don't think we'll get near that low. Maybe 1700. Upside resistance is going to be where support has been, which will be about 1800 in the short term. So we may settle into a 1725 to 1800 gold range in the short term, but we'll see how it goes. It all depends on where the dollar goes over the next month or so. And it looks exceptionally strong today. Let's look at a silver chart. Silver, like gold, is weakening, and it's broken support at 2075, and today it's testing $19 an ounce, which is the previous resistance level to the upside at 1885, where the second to lowest line on the chart is. When silver took off due to COVID, it went on a bullet from 1875 all the way to 29. And over the last 2 years, it's traded primarily between 23 and 27.65, as the chart indicates. In our last update, we circled that major move straight higher in June of 2020 and said silver looks like it could backfill into that space where it didn't really trade on the way up. And that's exactly what it's doing today. That's what the red arrows indicate. So if gold is on sale, silver's on a bigger sale right now. It is cheap relative to gold, and it is cheap relative to its price over the last 2 or 3 years at under $20 an ounce. This looks like a real bargain buy to us today. We like silver at these numbers. And here's the fundamental reason why. If you look at the gold to silver ratio chart, anything above 82 on the chart means that silver is exceptionally low relative to gold, and vice versa. Anything below 47 on the chart, silver is very strong relative to gold. Today, with a gold to silver ratio of about 92 to 1, it's spiking to the highest level we've seen in a long time, absent the March 2020 spike. The July 2020 spike that took it all the way up to 125 to 1, which was an aberration. So at 92 to 1, silver is very cheap relative to gold. And this looks like a great buying opportunity for physical silver. We see platinum and palladium next. Here's a 3-year platinum chart. Like gold and silver, platinum is trading a little bit under its major 2-year range of 900 to 1135. Today it's about 840 an ounce, so it's just a hair lower than the chart shows. These charts are as of close of business yesterday, July 5th. Platinum is used primarily in diesel, automobile, catalytic converters, and it's traded at a major discount to gold since the VW diesel crisis erupted in the fall of 2015. With platinum down under 900 and under 875, it looks pretty cheap to us, but seeing reasons why platinum should go substantially higher, especially in an economic slowdown, don't make a lot of sense to us. So it looks like a good value, but we would tend to shy away from platinum in favor of silver and gold in the current market. because we just don't think there's going to be that much impetus for it to move substantially higher on a rebound. We could be wrong, but I would tend to put my money into silver and gold primarily right now, while the two major metals that have currency value as much as commodity value are low. Platinum and palladium are more commodity metals. Now let's look at palladium. Palladium is the one metal of the four precious metals that's been holding value better in the recent week period that we've been going through, but is still expensive at about $1,925 an ounce today. It's cheap relative to where it's been, and you can see it's had a wide trading range of over $1,000 an ounce over the last 2 years. Palladium is used in gasoline automobile catalytic converters and has been enjoying a much greater demand over the last 2 or 3 years than platinum has, which accounts for about 50% of both its use in automobiles and platinum's use in automobiles. In addition, both platinum and palladium, about 50% of them come out of Russia, and about 50% of the annual supplies come out of South Africa. So we could see supply problems because of the Russian sanctions, which would benefit palladium more, which would benefit palladium in a bigger way should we get an economic rebound. But we don't think we're going to see that big of an economic rebound for a while, the way the economies of the world are going right now. So we like palladium at these numbers, but we still like gold and silver better. They're much less speculative. So let's talk about physical precious metals. Since May, physical demand for gold and silver, platinum and palladium have been lower, but the price dip that we're going through now is creating renewed interest. The US Mint 2 weeks ago announced drastic allocation cuts to its 12 worldwide distributors. They asked the distributors how many gold and silver eagles they would like for the rest of the year, so they could try and gauge what the demand would be versus their production capability. And the US Mint replied to the distributors that they were all going to get a lot less gold and silver eagles than they asked for. So we're seeing premiums on silver eagles pop back up a bit, and they're over $11 an ounce right now, which is extremely high. We're also seeing gold eagles, 1 ounce, half ounce, quarter, and 10th ounce premiums rising a bit. We do think if we get a demand wave that's sustained, premiums for gold eagles could jump pretty sharply. So that's the kind of situation we're in. The US Mint is again underperforming in a pretty decent demand situation, and that's going to be the case for the rest of the year. The silver squeeze was easing, but the current price drop is creating a demand surge. So we've seen premiums for silver maple leafs, silver Philharmonics from Austria, British Britannias, and South African Krugerrands all dipped to their lowest premium level about a week and a half, 2 weeks ago. But the demand for silver has ramped up on the back of this silver price drop. And now premiums are up about 50 cents dealer to dealer in the last week. And they're pretty firm. We have live silver available, so there's not delivery delays, except for silver eagles, which are backed up till August 31st now. We had a major order, I'm told, of about $20 million come into the market last week, which pretty much wiped the shelves of a lot of physical gold and silver, as well as vintage pre-1933 US gold coins, which has helped to fuel these higher premiums that we're seeing now. There's still physical silver on the shelf and physical gold, but US gold and silver eagle premiums are moving higher, and silver eagles, we won't see physical availability from the Mint until the end of August now. The good news is the US Mint has released their second tranche of platinum eagles this year. So we do have platinum eagles available at low premiums relative to the Mint's production costs. So get them while you can. If you want to get one for your collection, or if you want to speculate on platinum, that's a good alternative right now. We also have some Canadian platinum maple leafs available. I'm sorry. We also have some Canadian platinum maple leafs available. Palladium availability remains problematic. There's very little physical palladium in the world today. So it's hard to offer physical palladium to our clients right now. There's not very much coming out of either the mints or refineries. Let's take a look at pre-1933 US gold coins. We continue to like, in the current market, the $20 Liberties, the bigger $20 gold coins, minted primarily from the 1890s to 1907 in choice uncirculated MS63 condition and in MS64 near gem quality condition. The 63s, relative to their later brethren, the $20 St. Gaudens, have a lower population than the one grade higher Saint by about 2 to 1. Today, they're pricing just a little bit cheaper than an MS64 Saint. They're pricing at $21.60 on special, and they're about $800 less than their previous market high of $29.38. So they have a lot of upside potential and limited downside in the current market. We really like the $20 Liberty for scarcity and low premium. Moving one grade higher into a more speculative coin with better fundamentals, the $20 Liberty in MS64 condition has about 143,000 coins known versus 275,000 for the MS65 St. Gaudens. So like the $20 Liberty in 63, the $20 Liberty in 64 is about twice as scarce as its comparative Saint by price. Today, the $20 Liberty in 64 is about the same price as a MS65 Saint, but its previous market high is substantially higher, about $1,500 over today's price of about $23.80 per coin on special. So if you'd like to be in the private US gold vintage pre-1933 market, these are two coins that we recommend as best buys today. And remember, we're the only company that we know of in the United States that publishes price and premium charts for the vintage pre-1933 US gold coins going back to 1998 when we started our company. We've tracked the prices. So this is one of our analytical tools that we use to measure premium and price and relative value to other coins. And it's accessible to you if you go onto our website. So we hope that we can help you with your physical precious metals needs. If you have any questions, please call us. This is how you contact us, either by phone or by email. And that's our website at www.amergold.com. Thank you for your time. Thank you for your support. It's going to be an interesting summer and a very interesting fall. So best wishes and stay cool. So thank you very much. Appreciate your time.